Jay Patterson here for a let's call it a market update instead of a flash alert for Friday the 13th. I actually only just realized that today was Friday the 13th. I don't know why I didn't pick that up. I've been writing the date of 13/3 all day long, and I don't know why it just hit me this afternoon that it's Friday the 13th. So I hope that you're having a fantastic Friday the 13th, and that nothing bad is happening to any of you. I can certainly say that that is not the case for the markets at this stage. They are looking very scary indeed. And at the moment, on your screen here, you would hopefully be seeing the CNBC web page, and the ASX had a bit of a bounce into the close today, and it's actually looking like maybe we'll see a little bit of a bounce tonight in the U.S. as well. The futures are up, which is good, not by a lot, but they're up, and so I'll just talk about basically a bounce of what a bounce might look like. I'm also going to just relate to you a couple of really important concepts about what is going on in this market and why I don't think the downside is finished yet, and anything that happens at the moment in terms of being sort of a counter trend rally. So when I say counter trend rally, remember over the last few days I've been talking about the path of least resistance being to the downside, and the rate of change and acceleration to the downside is what is the current motion of the market. So nothing ever goes straight down in one fell swoop. You will get moments where things bounce and rally, and then tail off again. So the first thing I want to just touch on, I'm just going to pull up a quick chart here. What this chart is showing you is along the bottom of the axis here on the the y-axis is a percent loss. So -5, -10, -15, -20, and the black bars are the amount of money that you then have to make in order to recoup that loss. And so obviously quite simple. If you lose 5%, you need to gain 5%. If you have a 10% drawdown, you actually need to earn 11%, -15, 18, and so on. And so we're right now, just to put some context around this, we're right now sitting around a 25 to maybe 30-ish% loss. And so what that means is we need to see if we just take a 25% loss, we're going to need to see a 33% gain in the markets in order to be at break even, and so get back to an initial investment level. Now the good news, as I've been saying this all week for all of you, is that I have not had any of my clients get hit with any of this downside in the markets. Capital has been preserved and protected, and in fact, in many cases, most cases, in fact, money has actually been made on positions. And but this is a real important table, and what it illustrates is why, for example, it's better to take small losses as they come along than have a big loss, a big drawdown on capital. I mean, if you think back to 2008 when we had the market crash that took the ASX down, I think 40% or 45%, you then needed to have, if you just took, say, 40%, a 67% gain just to get back to break even. And we know that it took years for that to happen. So the ASX didn't actually get back to its all-time high, its previous all-time high, until I think last year at some point. I don't know if it was in the middle of the year or whatever, but it didn't get back to that 6,800 level until towards the end of last year, I think. That's 12 years it took the ASX to recover back to its original sort of high. That's ridiculous. So the moral of the story is don't step in front of this train that's moving towards you, which is the market, coming to basically pancake you. And as I've been also saying all week, this is what the global macro full cycle investing strategy is all about. It's the strategy that I use now. It is data driven, and the data, it's mathematically based. The data, I'm telling you, it will set you free and keep you out of making major blunders and major mistakes like stepping in front of a moving train. So I thought I'd just share that chart because it's really fascinating. Like, think about this, right? If you got a 60% loss your money, you got to have 150% gain. So this is why, ladies and gentlemen, if you find yourself in, and I will almost never ever do this again, buy individual shares because of this fact. If you are unlucky and step on a landmine, you speculate in some mining stock or something else, and it blows up by 60%, you're probably hosed. You're not going to get your money back on something like that. So anyway, you're not going to see me. I dare say it's highly unlikely that you'll see me buying individual stocks. Although having just said that, there might be one or two like Google or Apple or Facebook or some of those that I might dabble in and trade. But the liquidity on those is exceptionally high. So anyway, that's just a little lesson on that. Now, I want to talk about earnings and why I think we're not anywhere near being out of the woods yet with this market. And this is a table of what happened in the lead up and through 2000 and 2001, which was one of the last big market sort of crashes that we had. So the 2001 market crash was effectively sort of triggered. The trigger event was 9/11. But earnings were already getting hosed. And one of the things that I want you to just kind of key in on here, and earnings per share actually were getting hosed. I think I just said that. Anyway, if you look at this is 2000 first quarter, so this is from January 2000 through to the fourth quarter of 2002. And what you'll see is that earnings peaked. They peaked in the third quarter of 2000 and began to slow. And this is why this is critically important. Most of Wall Street missed this. Most of Wall Street has missed it again now because the same thing is happening. Earnings have gone negative. They've been declining and they're dipping down into the negative. And they will continue to do that because, as I have also reiterated several times in these flash alerts and other market updates that I do, the coronavirus impact will not be felt until months from now and quarters from now. Well, I shouldn't say quarters from now, probably next quarter and possibly the quarter after that, depending on how the coronavirus continues to disrupt global trade, travel, and all this other stuff. We could very well see earnings declines that are pale in comparison. That this 2001 event pales in comparison to the earnings declines that we may see as a result of the coronavirus disruption. Who knows? We just don't know. We have to wait for the data. But certainly, the rate of change, we have gone through a phase transition where earnings now are negative. Wall Street is asleep at the wheel, and there's no dead man switch, which is why we've seen these precipitous sell-off, because they just don't get it. And so this table, if you just change the dates on it, to 2019, first quarter 2019, right through to say fourth quarter of 2021, this could be very well a repeat of that. Obviously, I don't know that for sure, but this is the point about earnings slowing, is that the market hasn't really fully priced that in yet. Like, it's pricing in that coronavirus is going to be disruptive. We've come off an epic stock market bubble, like epic stock market bubble. And so it remains to be seen when the market figures out that earnings are going to be a complete shit show in the next couple of quarters, that we might see a further precipitous decline. So I wanted to just spend some time on earnings and how important they are, because earnings drive what goes on in the stock market. I mean, this is a fundamental thing. Like, if companies aren't earning money and their cash flow is negative, or their earnings are declining and negative, you can't get to these lofty valuations that you see in the stock market. It's just that simple. It doesn't matter what the story of a stock is or any of this other nonsense that a lot of Wall Street peddles to people. If there's no earnings growth, you're not going to see continued acceleration of share prices. So please, know that. Now, the other thing I wanted to just spend a moment, a bit of time on, is the volatility index. And this table, or chart, I should say, goes all the way back to 87. And as you can see, these peaks are highlighted in red. Now, we didn't have, I think this chart, yeah, it's from the 11th of March, so we didn't have the now extreme volatility that we're getting. And in fact, I believe the volatility index went up to 75. I'm just going to pause for a moment and grab that chart. Hang on. Okay, I think we're back on. So I've got I've got a chart here of the VIX open, and the VIX closed yesterday at 75. This is holy shit, your hair's on fire type stuff volatility. It's off the chart, literally off the chart. Massive spike in volatility. Now, that will probably come down a little bit overnight. The markets are showing a bit of a rally, etc. That'll probably come back. Does it come back into the low 70s, mid 60s? Does it get back to the 50s? I don't know. But this is unprecedented stuff. The interesting thing at the moment on VIX, and I'm not going to go into all the risk range stuff and the ranges of these things, but if you've been watching these over the last few days, you know that VIX above 31 is no go. No go on buying any equities, anything like that. VIX above 51 is, almost like I want to jump out the window. The market's so bad. VIX at this level is just, just close your laptop, go to the beach, and hope that everything gets better. That's obviously, hope is not a risk management strategy. I probably shouldn't have said that, but nevertheless, volatility at this level is ridiculous. And just back to, if I can just jump back to that. Sorry, I need to get back to that screen. Let me just shrink that down. Here we go. Back to this chart here. The last couple of times that this happened were 87 and then in 2008, where the VIX was at a level, well up above the 60 mark. And even back in 2008, it bumped, I think, a little bit higher. But we are at unprecedented levels of volatility, and it's not good for the market, and it doesn't resolve in one or two trading sessions either. So we're going to be probably at this elevated volatility level for a little while, and that just continues to signal to kind of do nothing in the markets. Now, when I say do nothing, there is a playbook for this, and what is coming and what the market's pricing in, and it's going to be interesting to see how the market trades in terms of bonds over the course of tonight, because I'm looking for interest rates. I'll just see if I can expand this out so my little bubble moves off what I want to show you. So as you know, two of the key interest rates that I look at are the 2-year and the 10-year. They seem to drive a lot of stuff in the U.S. market. So does the 30-year, and they've popped. They've popped nicely. Now, the Fed is almost certainly going to have to cut at their next meeting, which I believe is next week. And the question is, will they cut by 50 basis points or 75? The market is kind of pricing in a 75 basis point cut. And whilst that might sound to you that that's great, they're going to, their policy responses are going to be cutting interest rates, and they're going to be flooding the market with liquidity, and they're going to be trying to make sure the banking system doesn't fall over and all this sort of stuff. But let me tell you something, ladies and gentlemen. This is a rerun of a movie that was played in 2008. And so we know how that ended. The market continued to effectively crash, and I got really, really bad. And there then had to be these fiscal measures, the government stepping in. Hank Paulson, Bazooka Hank, with his I can't remember what he called it back then. There's been so many QE versions. He had some name for it, and it was, a few $100 billion injection into the market. And again, the market sort of liked it, and then it didn't like it. So I guess the ramble that I'm on here at the moment is to say that if I see rates going up to the top end of a risk range, don't be surprised to see on the trade reports that you get every day that I've bought some more bond positions because that'll be an opportunity to reload on bonds in anticipation of further rate declines. That's how this works basically is there is a risk range for various things like gold, interest rates, certain securities that I look to own given the quad that we're in. And if it goes to the top end of the range, I'm looking to sell some. If it goes to the bottom end of the range, I'm looking to buy some. And that's on specific things. It also has to be within a certain trend. So they have to be trending. Is it bullish or is it bearish? If it's neutral, then you do nothing. And it depends on what it is. If it's for example, a stock like Facebook is well and truly in a bearish trend, I would look to be short Facebook, but I can't do that. I wouldn't do that, I should say, in a long only retirement account. So the most I would do on that would be long something else like treasuries, or I would be in cash or a variety of other positions for the playbook. I think that probably is something that makes sense to all of you. So I think that's probably about all I have to say. Actually, there's one final thing I think I'll touch on, and that's to look at some of these charts. Here's a great one, right, of the 10-year yield. Back in early 2020, 10-year yield was up there around 180, 190, and it just fell off a cliff. And it's bouncing, but it's headed lower. Gold has been on a tear. It's pulled back a little bit. This chart's a little old. It's pulled back a little bit into the 1575 area. Again, it's almost straight up since November of 2019. And I'll be looking to buy more on this pullback. If I get a pullback tonight, I will be buying more gold. ASX, Whammo, thank you. Thanks for coming. Once again, that is just almost a precipitous straight down decline. Similar with Kospi and some of these other Thailand, there's a few on there. Anyway, that's charts are interesting. I hope you find some value in those things. And in fact, I hope you're finding value in me doing these more frequently. Certainly the market conditions are warranting more updates from me, but hopefully you're getting some value out of this. And again, just to close, I do want you all to be at peace knowing that you're not getting body bagged, or your wealth, I should say, is not getting body bagged by this current market conditions. And I'm really, I can't wait to see what happens when we start to get signals to buy equities and to buy growth and to buy these things, because, out of the back of all this downside and all this bad stuff that's happening, really good things will come. And so the timing of it is going to be critical. But what I can probably preface for you is get strapped down and ready to go for when the market turns. And the interesting thing is, and I'll just preface this, I'll plant the seed, is when I start to do that, you'll probably be like, oh, what are you doing? Because it'll probably be at that moment of time when it seems like it's never going to get any better. And that will be the moment when we will, when I will allocate cash to positions. And, the market's not going to go straight up immediately. Never does that. Markets tend to go straight down very quickly, but they don't go back up quickly. There's a long period of time. So hopefully then we will be in a position where we'll get a nice 3, 4, 5, 6 quarters of steady rise in whatever it is we end up buying. So with that, guys, have a great weekend. Hopefully you're not too worried about the coronavirus. I'm going to publish on the boardroom, so jump in there if you're not in there already, some interesting slides about the coronavirus and how it's unfolded across the world and all this. I think there's a little bit of scaremongering going on still with the coronavirus. It seems to really be afflicting a certain segment of the population, which are the elderly, who are already sick, particularly elderly people who smoke, obese, people who are obese because there's a high respiratory issue with the coronavirus. So people who are obese, typically they have breathing problems and these sorts of things. And oddly enough, it's not impacting or afflicting children very much unless they're already really sick. So I think it's probably a good thing that the government's getting on top of it and doing some of these things, but I don't know. Part of me is a little bit of a conspiracy theorist. Like, what is really going on here? Is this virus really, really this bad? Is the reaction by the government just a precautionary thing, or is there something else going on? And time will tell. I can't make any judgment call. Time's going to tell. So anyway, be safe out there. Any questions that you might have about any of this stuff, don't hesitate to give me a call. I do hope, though, that all these updates are giving you the confidence and the satisfaction that I'm at the switch, I'm bolted in the chair watching this stuff, and that you trust me with your money and that I'm doing the right thing with it. So with that, have a great weekend. Talk to you soon.